Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about franchising, because obviously going and starting your own business is something that a lot of people contemplate. They kind of, there's this mentality that you can't really build significant wealth by working for someone else, by just being an employee. I don't know if that's really true in all situations. I've seen situations where professionals have done incredibly well as an employee and really just probably weren't suited to establishing their own business, so that was really the best thing for them. And I don't think there's any right or wrong here. I think it's got to do with where is your interest and where is your abilities, and anyone that starts a business at the beginning is typically no good at it, and you learn along the way, of course. So it's not about whether you have all the knowledge today, but I guess it's whether you can learn that and learn it fast enough to be able to build a sustainable business. Well, one way in which you can mitigate that risk to some extent is by buying a franchise, and that's what we thought we'd talk about today. So let's start with some of the pros. Well, we're going to talk about the pros and cons. Let's start with the positives, of course, Mena, of purchasing a franchise business.
Of course. So first and foremost, obviously, you're buying a brand. A brand that's already been tested and tried. It's got the recognition, got the credibility, got the framework, and the customer awareness of that known brand. Now, obviously, you're not buying a business from scratch. You've got to pay for that brand. Consider it such like goodwill, but it fast tracks your revenue. All right. So a lot of businesses aren't too profitable from day one. In fact, not many businesses are profitable from day one. Whereas with a franchise, it's more a destination. People know you. They're aware of you. They're coming to you for whatever product or service you're selling.
So we've spoken about the 3 Ps before in terms of, when thinking about a business and making a business as strong and as profitable as possible, you've got to think about the 4 Ps. So people, product and process. So that's the product that Mena just sort of spoke about, is really the brand recognition that comes along with that. The second one is process. So you're buying a proven business model. Hopefully what a franchise does is they give you all the systems, training and support, what's required to deliver either the product or service that you're selling. And the whole thing about building processes is you can't build them perfectly from day one. It's really about building a process and then refining it over time. But the other thing too is, for most businesses, things evolve. So those processes need to evolve as well. And so that's the other benefit, is if you've got a franchise, they're going to continually evolve their processes, and you don't need to do that sort of trial and error process.
The next thing is around support. Now, obviously, franchisors, or at least good ones, provide extensive support, training. They tend to have in-house counsel to do things such as lease negotiation, staff training, HR, marketing compliance, and so forth. So you're getting all that from the day dot. These things are generally things that you, if you're to start yourself, would need to build out over, and will take many years to do so, build out and get the right people behind you. Whereas with a franchise, you tend to get that kind of support from day one.
Now, there'll be a franchise fee, of course. That's an upfront fee that you'll have to pay for the system and process. And maybe there'll be, again, depending on what the business is, some capital cost associated with, a fit out of a premises or some plant and equipment, whatever it might be. So there's going to be an upfront amount that you're going to need to pay to buy the franchise. And because these systems are proven, they've got a track record, most franchise businesses have a relationship with a lender or maybe even multiple lenders, which are willing then to lend a percentage of the franchise business. Most of those businesses or banks will lend somewhere between 40 and 60% of the franchise cost. So you'll need to stump up still a little bit of cash. But the benefit is that trying to lend for a business that doesn't exist yet in Australia is really challenging. So, particularly if you don't have security, even if you do have security as in your own home or investment properties, it's still really hard to do. And the interest rates are going to be lower because the perceived risk is lower as well. So at least it leverages, if you've got a certain amount of cash to start a business, you've got greater leverage with the franchise business than one you're starting from day dot.
The next thing is around economies of scale. Now, franchise groups tend to benefit from obviously greater buying power from their suppliers. So, obviously if a franchise has 50 outlets as an example, they've got 50 people or 50 stores that they need to fill. They've got buying power. They can go to a particular supplier and squeeze them on price, because any supplier would obviously want in their right mind to fill 50 stores with a particular product or be a preferred supplier for that particular franchisor. So it really gives you the ability to sort of improve on your margins and reduce your input costs.
Next thing is marketing advertising. So, most franchises will have you make a contribution towards their marketing advertising pool. And the benefit is, again, you get those economies of scale. So whilst you as a business might be contributing, say, $50,000 a year, that's not going to, in terms of marketing, that's not really going to buy you much in the way of advertising and cut through. But if you've got 100 franchises around Australia contributing the same amount, well, all of a sudden you've got a massive marketing budget, and hopefully you can leverage that to a greater extent.
Now, we'll talk about some cons. We've obviously highlighted some key benefits of using a franchise, but some cons tend to be around, the first one tends to be around costings and ongoing costs. Now, from our experiences, the initial franchise fee tends to be quite substantial, because obviously there's the franchise fee, and then if there's a physical store or similar or sort of setup costs associated with your service provider, then there's a lot of sort of cost associated with that. Now, although a lot of it, like Stuart mentioned previously, can be financed, you still need to pay that eventually. So it can be quite expensive. Now, obviously there's ongoing royalty fees as a result of your revenue. It's usually tied to your revenue. It's usually a percentage of your revenue, as well as a marketing fund. So there's two different levies that tend to be imposed by a franchisor, which are both tied to your revenue, which in my view can limit your growth, because obviously I don't think the royalties, or at least especially the marketing fund, will change based on how much output you have. So you're basically giving the franchisor more money for your hard work. So I don't think it's the most perfect model in terms of applying a percentage. And it can be quite costly, and it can limit your ability to grow the business
and achieve scale, right? Because the whole thing about growing your business is hopefully, by selling an extra dollar, you're making, more profit. And you can do that by making sure that most of your costs are relatively fixed, and then scaling, adding more scale to that cost base, and therefore you make more profit. But if your fees are always linked to income, you're not going to get much scale. You'll make more dollars in dollar terms, but percentage terms, you're not going to achieve that scalability. The other thing, Mena spoke about sort of economies of scale in terms of buying power, but also need to look very closely in the agreement, because if the franchise, and we've seen it in a lot of situations, the franchise will go and buy, consumables or goods, whatever the raw materials are in the business, and then on-sell it to the other franchisees, and at a higher margin. So that, again, that's another way for them to make money, when the poor business is sitting there thinking, well, we could buy this cheaper if we just went direct to the supplier.
Or supply rebates, actually. A lot of franchisors tend to get supply rebates directly rather than going to the franchisee.
Yeah, I mean, there's all sorts of things that people need to start thinking about, and we'll talk about that at the end as well. Look, another downside is lack of autonomy. One of the benefits of building your own business is you can run your own race. That's a pro and a con, by the way, because you might end up making a lot of dumb decisions, and you're, at least to some extent, the franchise protects you from yourself. But, if you have, a lot of creativity, you are good at business, you want to implement certain improvements, well, some franchises can be quite rigid and might not allow you to do that. So you might see opportunities in your business that you would like to explore, but you're not allowed to explore that because it contravenes the agreement. Just something you need to be aware of when you go into those sorts of arrangements.
There's also risk around brand damage. So obviously, as we sort of touched on, as a pro, it could also work as a con, in that your overall success is tied to the brand reputation. Now, if there's been a scandal or operational issue in the franchise or location, such as we saw, with various sort of large franchisees a few years ago around fair work and underpaying staff and so forth, it can really hurt your own business. It really handcuffs you. You're really tied to them. It's not like you can decuff yourself and say, no, I want to trade as something else, or I'm different to these guys. No, you're taken to be one brand, one uniform, basically, that is associated with this scandal or operational issue.
And I think we've seen that. I mean, it's not a franchise, but from an investor's perspective, Tesla is obviously linked to Elon Musk. You can't really separate the two, and that's a pro and a con. Sometimes it works really well for the company and they sell more cars because of it. Other times it's a negative. But as an investor, like, I don't invest in direct stocks because I invest in ETFs. But if I was an investor, I don't think I'd buy any company that has a high profile CEO, because that's just another risk that's not necessary to take. The next one is contractual restrictions. Franchise agreements can be long and very complex, and they're going to deal with things like renewal of the agreement, termination either by yourself or by the franchisor, resale of the business or restrictions of sale of either parts of the business or the whole business, territorial exclusivity, these sorts of things. It's really, really important that you have an experienced lawyer look over these sorts of agreements and you fully understand. And I think the thing with these agreements is you've got to look at them through the lens of an unhappy person, right? Because you wouldn't be buying the franchise if you were unhappy with them. Of course, you're going to be happy. That's an obvious situation, but things go wrong when you take the rose-coloured glasses off, and that's where you can identify holes or problems. So you might say, well, I think this business is fantastic and it's run really well, all those sorts of things, but it's until when things go bad that's where you need the protection, and that's the lens of which you need to look through those agreements.
So in summary, a franchise is basically a good idea or a good fit if you're sort of new to business and want a sort of lower risk or entry point. So basically, I think we've sort of highlighted, the pros and cons, and, what we sort of tend to find that is a franchise is a good idea or a good fit for you if you're sort of new to business and want a sort of lower entry point or a risk entry point. And you're sort of happy sort of to maintain a model and follow a typical operating system, and typically be happy with the business that sort of somewhat has a ceiling in terms of its growth. Obviously, the benefit you get from a support network, there's pros and cons to every business, whether you do it yourself or go down a franchise business. So it's really important to sort of understand and when you should go down the pathway of a franchise, or when you should avoid it. So you'll typically avoid it if you value your independence and want full control, or if you're quite entrepreneurial in nature and want to innovate, experiment, or differentiate your product from, competitors out there. It's not for everyone, but it is that there's definitely a portion of the general public that do or would benefit from a franchise. And like sort of Stuart mentioned earlier, that not everyone is suited for business, and a franchise is sometimes a happy alternative.
And it could be a stepping stone too. Like, I know in financial services there's some franchises, they might suit some people, and there might be, look, I'll do it for 5 years as long as there's a good exit clause. I know what I can do. I can exit the business and crystallize that value. It could be a good way to start. I know people that have done that. Now, whether they do it again, who knows, but it can suit some people. I think first and foremost is there's a lot of shit franchises out there, right? That neither Mena and I would go into, even if we were of a mind to do that. So getting some independent advice is critical. So seek advice from your holistic accountant. Hopefully they've got experience in these matters. They'll be able to critique the business model. They'll be able to critique the fee structure. They'll be able to identify some of the risks. Maybe not all the risks. Some things are unknown. But I think getting some independent advice from someone that is entrepreneurial minded is well worth investing in. Okay, that's it from us for this week. Bye for now.